Accounts receivable. Using examples, we will walk through how accounts receivable are recorded, written off, and how an allowance for bad debts is calculated. When a company makes a sale, they're paid in either one of two ways. Either they receive cash or they receive a promise to pay at a later date, i.e. an accounts receivable. We're going to abbreviate that as AR. Accounts receivable accounts are maintained by customer for purposes of sending out statements as well as to analyze individual receivables. If a customer wants to call and ask that their receivable balance or their credit line be increased, they will look at the credit history associated with the receivables for that customer for that company, as well as their general credit worthiness. The individual accounts receivable accounts are maintained in the accounts receivable subsidiary ledger, and the sales associated with credit sales will be recorded in the subsidiary sales journal. However, the general ledger will just have one total for accounts receivable and sales. Sales, the journal entry associated with sales on accounts receivable. So accounts receivable will be debited and sales credited. Then when the cash is received, accounts receivable will be credited, essentially showing that the receivable is no longer due to the company or outstanding, and cash will be recorded or debited as being shown as having been received. Companies can extend credit to customers such as Sears and JCPenney. They still have their own credit cards. However, most companies will accept third-party credit cards or debit cards, specifically the Visa, MasterCard, Amex, or Discover cards. Why don't most companies offer their own credit cards to customers? They'll receive interest on the credit card balances, but why don't they offer more of them offer credit cards to their customers? Well, primarily it's because it's expensive to do so. They will earn the interest on the accounts receivable, but they'll also have to pay for credit reports, the staff to determine credit worthiness, to record the sales and payments associated with accounts receivable. So when there's a sale made, they have to record that. Then when payments are made, they have to record those, and also calculate any interest due on the account when the statements are being ready to be sent out. Send out the statements, collect on the accounts receivable, as well as to deal with the customers who pay slowly or not at all. All of these activities are very expensive because they require staff or software that will be expensive, and the interest earned on the accounts receivable must absorb all of these costs of staff or the software that they're using, and also will not only the interest have to absorb the cost, but it will also create a profit in order for it to be profitable for the companies to do so. However, extending credits to customers opens up avenues to new customers more than if the company were just simply accepting cash only. Therefore, many companies choose to accept third-party credit cards. We will use Visa as an example because Visa determines creditworthiness, sends out the statements, and collects from the customer. So all the company has to do, the merchant company has to do, is just simply accept the Visa card. The company can collect its cash quicker, doesn't have to deal with the expense of additional staff, nor worry about collections. Visa will work on an interface between themselves and the merchants to provide proof of the transaction. Some will just simply interface with the company's own cash register system, and in some instances you'll see a merchant have a side interface outside of the cash register system where you slide your card, and that's the interface between a merchant and Visa. Typically that system's set up for a merchant that's not a newer merchant or a merchant that doesn't have a significant footprint and type of or a store. It's sort of a kiosk type of venture that you'll see in a mall, something like that. The cost of using the third-party credit card providers is a negotiated percentage that varies from third-party provider to third-party provider. So the cost of using the third-party credit card providers, the Visa and MasterCard and Discover, is a negotiated percentage between the merchant and the third-party provider, and it varies between Visa, MasterCard, Amex, and Discover. Amex is traditionally the most expensive of the third-party credit card providers. Additionally, the transaction fee is between 1 to 5% on the transaction. The third-party provider, Visa, etc., takes this fee and then remits the remainder to the merchant company. Depending upon the relationship and the attractiveness of the merchant to Visa, the merchant can receive cash immediately or at a later agreed-upon date. So somebody that has a large store, say like Walmart, will probably receive their cash immediately. A smaller store, say for instance a dress store in a mall that doesn't have such a large economic footprint, would probably wait and settle up with Visa towards the end of the month. So if the merchant company is going to receive their cash immediately, the journal entry would be cash $96, credit card expense $4, and sales $100. 4% will be charged on the transaction. If they're going to receive the money later, the journal entries would be accounts receivable from Visa, $96, credit card expense of $4, sales in the amount of $100. Then when the cash is received later on, cash debited $96, and then the receivable from Visa will no longer exist, so it'll be credited. When a merchant, now the prior example was for third-party providers. Now we're going to switch topics and we're going to talk about merchants when they offer an in-house credit card. So this would be something like Sears or JCPenney. When merchants extend credit to customers, it must record any bad debts as an expense of doing business because they aren't going to collect on every receivable that they extend to one of their customers. They have to record the bad debts, the customers that don't pay. There are two methods to do this. The first method is the direct write-off method, and the second method is called the allowance method. The allowance method is calculated in three ways: the percentage of sales, the percentage of receivables, and the aging of receivables. Let's first look at the direct write-off method. The merchant does not predict which bad debts it expects to receive, but writes off each customer if it cannot collect on the accounts receivable. So it doesn't predict or estimate what bad debts would possibly go wrong based upon their experience in their line of business. So the write-off is an expense of doing business, so it is considered bad debt expense. So when a specific customer they cannot collect from them, they will debit bad debt expense. That will be an income statement account, and then they will write off the receivable associated with the customer, and that will be accounts receivable, customer A, the same amount as the bad debt expense. Now, however, if the customer does subsequently pay, and it does happen, the merchant will reverse the prior journal entry, and then this reestablishes the customer's accounts receivable in order to track the customer's credit history. So they will reverse the prior entry. Now, say for instance, if someone gets in trouble financially and they can't pay and they take a very long time to pay, and then when they do receive some money, they go back and pay the merchant because they did borrow the money and they feel as though they have a moral obligation to pay, then this customer, if they want to charge in the future, they may reestablish the accounts receivable with them, maybe not then, but maybe later on, but they will take into consideration the fact that the customer did pay and their accounts receivable was reestablished, and then the subsequent payment was recorded against the receivable. So it's a way of maintaining credit history, because sometimes people do get into trouble and then wind up later in life doing better financially and being more responsible. When the cash payment is recorded, then they will record the cash and then also show that the customer no longer owes the money, but this credit history will be preserved. The direct write-off method is not GAAP, although it is used by some companies if accounts receivable is minimal. There are two major concerns if you use the direct write-off method when you take into consideration the principles of GAAP. First of all, there's a violation of the matching principle. Since it normally takes a while before a customer's account is deemed uncollectible, it could be 120 days or plus 120 days. So it's going to take a while before you determine that you can't collect on the account. The sales were 120 days ago, so the sales associated with the accounts receivable could easily be in a different financial statement period than when the expense is recorded. And so the sales and the expense wouldn't be matched. Then also there's a materiality concern. If the AR accounts receivable balances are significant, then the materiality constraint is violated and will require the merchant to estimate the bad debts. So if you don't record the bad debt in the time period when the sales are recorded, then your accounts receivable will be overstated as well as your sales overstated. And in subsequent periods, when you do write it off, then your sales will be understated in that period, as well as the income statement will be understated because the expense will be recorded in another period. The company makes an estimate of bad debts to match the expense when they use the allowance method. So now we're looking at the allowance method. So now the company will make an estimate of bad debts to match the expense in the current month. The accounts receivable will be reported at its net realizable value. Although the allowance can be calculated in 3 ways, the adjusting journal entries are the same. It will be bad debt expense, and now instead of writing off a specific account for the accounts receivable, you will be using an account called allowance for bad debt because you're just looking at now at the accounts receivable in its totality. The allowance for bad debt or allowance for doubtful accounts, I may use either term, is a contra asset account like accumulated depreciation. It is credit-based as its related account, accounts receivable, is debit-based. So instead of looking at waiting for an individual account to go bad, you look at accounts receivable in its totality using your experience, and you determine how much of that accounts receivable you expect that will not be collectible, and that is recorded to the allowance for bad debts. Now let's look how it would look like on the balance sheet. In this instance, we would have accounts receivable in the amount of $100,000. Our allowance for doubtful accounts or allowance for bad debts would be $1,500, and the net realizable value that would show on the balance sheet, just like we did when we had assets and accumulated depreciation, it's called net realizable value when you speak about accounts receivable, would show as $98,500. The original adjusting journal entry established an estimate based upon experience but is not related to a specific customer's account, but rather accounts receivable in its totality. When a specific customer's account is subsequently written off because it actually did go bad, the journal entry is the allowance for doubtful accounts, $520, accounts receivable for customer A, $520. Note, the allowance is reduced. So the allowance is reduced. The debit recorded against the credit-based balance. So we're going to record a debit. Remember, the allowance for doubtful accounts is a credit-based account. So now we're going to record a debit against the credit-based account, because a portion of the estimate is no longer needed because the customer's accounts receivable is actually written off. So we estimated the accounts receivable in its totality. We should see $1,500 of them not be able to be collectible. Well, now we've realized the fact that $520 of that is not collectible. So now the balance in our allowance for doubtful accounts should be $980, because part of this balance that we assumed would not be receivable, we've seen that's come into being, and so now our balance should be appropriately reduced. Note also that bad debt expense is not recorded because the expense was matched against the associated sales in the earlier principle, so the matching principle was not violated. So when this happens in a subsequent period, it goes against the allowance for doubtful account, not bad debt expense. Since both the allowance and the total amount in accounts receivable are reduced by an equal amount, this journal entry will have no effect on net realizable value. So now let's look at that. Originally, our accounts receivable were $100,000. Allowance for doubtful account was $1,500. Net realizable value was $98,500. Now we've written off a specific accounts receivable for $520. Our allowance for doubtful account has been also reduced by $520. See here? And so now our net realizable value is the same. If the customer does subsequently pay, again, we will reverse this part of the allowance that we originally did. So we will debit the accounts receivable for the customer to reestablish their account. We will credit the allowance for bad debts in order to realize the fact that this was not needed as a bad debt allowance. And then when we record the cash, and then the accounts receivable for that customer will be shown as having been paid off. Now, let's look at how we would calculate this. All of those prior to this were the journal entries, and it's the same irrespective of the manner in which you calculate it. But now we're going to talk about what the amount should be. So we're going to look at the way we can calculate what the amount should be. There's the three methods. There's percentage of sales method, the agings of receivable method, and the allowance for, the percentage of accounts receivable method. So let's look at the percentage of sales method, often referred to as the income statement approach. It focuses on sales. So the focus is on sales. It assumes a percentage of sales will not be collectible based upon the merchant's credit policy and current economic environment. So our current month sales are $90,000. Experience has shown that 2% of the sales will be uncollectible. Our calculation would be $90,000 multiplied by 2%, or $1,800. Our bad debt expense will be $1,800, which we'll record in the current period, and our allowance for bad debt will be $1,800. This calculation is repeated each accounting period, so each month, if we're using monthly accounting periods, or quarterly or yearly, and it will be based upon the current period sales. The allowance for bad debt balance is not considered when using this method, so it is just booked each month based upon current month's sales. The percentage of receivables method. This is the second calculation, often referred to as the balance sheet approach. The balance in accounts receivable is considered, and the adjusting journal entry is calibrated to match the current balance in the allowance for bad debts. I will explain what that means in just a moment when we go to the next slide. It assumes a portion of the accounts receivable will be uncollectible based on the company's experience and current business environment. So let's look at this. We have an accounts receivable balance of $10,000 and 1% is deemed to be uncollectible. Same scenario over here. Over in this one, we have a credit balance in the allowance for bad debt. And in this instance, we have a debit balance in the allowance for bad debt. Accounts receivable, $10,000, uncollectible, $1,000, both scenarios. In both scenarios, we're projecting that our allowance for bad debt balance at the end should be $100. That's what we should have based upon the balance that we have in accounts receivable. Now, in the allowance for bad debt account, we start off with a credit balance. Our adjusting journal entry will be $75 and will bring us to the projected allowance for bad debt balance that we should see of $100. Bad debt expense, $75, allowance for bad debt, $75. If there's a credit balance in the allowance for bad debt, then subtract this balance from the projected allowance for bad debt balance. All right. Going all of this. If we're expecting that we should have at the end of the process of booking the adjusting journal entry, we should have a $100 balance in the account, then we will take the credit balance, the current credit balance, subtract it from what we project, and that will be our adjusting journal entry. However, what happens if we have a debit balance to start out in our unadjusted trial balance? So now we have an adjusting journal entry for $325 as a credit to bring this balance to $100, which is what we project should be in the allowance for bad debts. If there's a debit balance in the allowance for bad debt, then add this balance to the projected allowance for bad debt balance. So we project that it'll be $100. We have a debit balance of $225. Adding the 100 to the $225, our bad debt expense will be $325, and our allowance will be $325. Now let's look at the third method. It's called the aging of receivables. The journal entries are not any different than the percentage of receivable method, but just the calculation is more complex. The focus is on layers of accounts receivable based upon how long the accounts receivable have been due. Various percentages are applied, with the larger percentages applied to those balances which have been outstanding longer. These percentages are based upon the company's experience and current economic climate. The percentages are applied against each layer and added together and become the basis for the adjusting journal entry. And again, you'll have to calibrate it in relationship to the current unadjusted trial balance that is in the allowance for bad debt. All the dynamics depicted earlier for the percentage of receivable method apply for this method when you're talking about how to put together the adjusting journal entry. So let's look at this, the calculation. It's not very difficult. It just is wordier than it actually is just to look at it. So these are our days outstanding, 0 to 30, $5,000 there, 31 to 60, $2,000, 31 to 90, $1,000, 91 to 120, $1,500, and then 120 days plus $500. So these are all of our individual layers in accounts receivable. And then these are the percentages that we would apply, assuming which debts we assume, which of the accounts receivable we assume to be bad debts. And so we look at each one of these percentages, and the older the accounts receivable is, it yields a larger percentage, the more likelihood that it'll be uncollectible. We apply the percentage against the balance, that 0 to 30. And so that would be the ending calculation. 1%, 31 to 60 days is $2,000. We assume 1% of those will be uncollectible. And looking at each one of these, and then we just simply add up each of the percentages together. So let's compare the two methods and just go one more time around and look at it so we are oriented to what we're doing. So bad debt is estimated, and bad debt is not estimated, and adjusting journal entry not prepared. I'm sorry, I should correct that. But the bad debt is not estimated, and adjusting journal entry is not prepared. So bad debts in this instance is estimated. Our bad debt expense would be $1,500. Allowance for bad debts, $1,500. The write-off of a specific customer, bad debt expense, $520. Customer A, $520. Write-off of a specific customer under the allowance method. The allowance for bad debt will be debited as opposed to bad debt expense under the direct write-off method. Still, the same customer, their accounts receivable is reduced. The recovery of a bad debt, again, accounts receivable will reestablish the customer, and then we are going to credit bad debt expense on the direct write-off method, and under the allowance method, we'll be crediting allowance for bad debt. Same journal entry to record the cash and the customer's payment. Now, let's look at a few more issues when it comes to accounts receivable. We'll look at two more issues. Sometimes companies will sell their receivables to a bank or a factor in order to realize their collections earlier. So they sell them to the bank or the factor in order to get cash on their accounts receivable quickly. The bank or the factor will take a percentage of the accounts receivable as their fee, and then the bank or the factor will assume the risk of collection. So the journal entry on behalf of the company would be cash, $19,200, factor fee expense, $800, and then accounts receivable, $20,000. And in each instance, you'd be given the factor fee expense or percentage associated with selling to the bank or the factor. Now, last issue, pledging receivables. Companies can also pledge their receivables as security or collateral for a loan. The company still has the collection responsibilities and still carries it on its balance sheet. No journal entry is required since the ownership doesn't pass to the bank or the factor. However, these facts must be disclosed in the notes to the financial statements that the accounts receivable has been pledged as collateral for the loan.